Nobody paid much attention to what Graham Tate decided in 1984. He was not the largest dairy farmer in the Waikato. He did not have the newest equipment or the most impressive herd numbers. He had 210 acres outside Te Awamutu, 185 cows, and a debt structure that his bank manager had described, without particular enthusiasm, as conservative. The neighboring farms were larger. Several of them had expanded aggressively through the early 1980s when milk prices were strong and land values in the Waikato were rising, and the logic of growth had seemed self-evident to anyone paying attention to what the market was rewarding. Graham had paid attention to the same market. He had looked at the same prices and the same land values and had reached a different conclusion about what they meant for his particular operation. In the spring of 1984, when his bank had offered to extend his operating credit to allow him to add 40 cows and lease an additional 60 acres from a neighbor who was looking to reduce his workload, Graham had declined. He had told the bank manager that he was comfortable at his current scale, that his debt was at a level he could service without difficulty, and that he was not interested in taking on additional obligations to grow an operation that was already meeting his requirements. The bank manager had noted this and moved on to the next appointment. Nobody wrote it down. Nobody thought it was worth discussing at the dairy co-op or the farm supply store. A farmer had been offered credit and had not taken all of it. This happened occasionally and was not a story. 3 years later, it was the reason his farm was still his. Nobody noticed what he did back in '84. That's usually how it goes. The decisions that end up mattering most, nobody's around when you make them. Just you and your numbers sitting at the kitchen table trying to figure out what's right. The New Zealand dairy industry in the mid-1980s was operating in an environment that had changed more rapidly than most farmers had anticipated or planned for. The Langa government's economic reforms, begun in 1984, had moved the New Zealand economy toward deregulation at a pace that restructured several sectors simultaneously. For dairy farmers, the most significant changes were the reduction and eventual removal of agricultural subsidies that had cushioned farm incomes through the late 1970s and early 1980s, combined with interest rate movements that accompanied the broader monetary policy changes of the period. The interest rates that Waikato dairy farmers faced on their borrowings moved sharply through 1985 and 1986. Farms that had borrowed heavily to expand during the years of strong milk prices and available credit found their debt servicing costs increasing at the same time that the removal of subsidies was reducing the effective price they received for their milk. The combination was not survivable for all of them. By 1987, the pressure on the Waikato dairy sector was visible in ways it had not been 3 years earlier. Several farms in the Te Awamutu district were in active negotiation with their banks about restructuring arrangements. 2 properties within 10 kilometers of Graham's farm had been sold, not by choice, during 1986. One to cover a debt position that had become unserviceable, one at the insistence of a bank that had lost confidence in the operation's ability to recover. The land prices at those sales were below what the farms had been appraised at in 1983. Graham watched this. He went to the sale of the closer property out of respect for the family. They had been farming that ground for 20 years. And because land sales in a district told you things about the direction of values that the bank's appraisals sometimes lagged behind. He drove home from that sale and sat in the truck in his own yard for a few minutes before going inside. His own position in 1987 was the product of decisions that had accumulated since 1980. Decisions that had not been dramatic individually, but that had built, year by year, into a structure that was meaningfully different from many of his neighbors. He had not expanded the herd beyond what his own acreage could carry comfortably. His 210 acres had a carrying capacity he had assessed carefully when he bought the property in 1976, and he had managed to that capacity rather than pushing against it. When the opportunity to lease the additional 60 acres had come in 1984, the arithmetic of leasing had looked acceptable at the milk prices of that year. He had run the numbers across 3 scenarios: prices holding, prices declining 10%, prices declining 20%, and found that the lease only worked in the first scenario with any margin to spare. The second and third scenarios produced servicing problems of varying severity. The milk price had not been that volatile in recent years,
But it had been that volatile at various points in the decade before, and Graham had seen enough of the industry's history to know that the price environment of 1984 was not guaranteed to be the price environment of 1986 or 1988. He had looked at the 3 scenarios, sat with them over a weekend, and told the bank he was not interested. He stayed at 185 cows on 210 acres. He had also paid down his land debt ahead of schedule in 1982 and 1983, when milk returns had been particularly good. In both years, he had made additional principal payments beyond his required obligations, 8,000 New Zealand dollars in 1982 and 11,000 New Zealand dollars in 1983. His accountant had questioned the decision both times, noting that the after-tax cost of the debt was low enough that the capital was probably better deployed in herd improvements or pasture development. Graham had listened carefully and disagreed. His reasoning was not financial in the strict sense the accountant was applying. It was that a farm with less debt had more room to absorb a bad season, room to make decisions from a position of stability rather than necessity, room to wait when waiting was the right answer. That room did not appear on a balance sheet as an asset. It was real, nonetheless. His land debt at the start of 1987 was 94,000 New Zealand dollars, down from 163,000 New Zealand dollars when he had refinanced in 1979. His land was appraised at approximately 310,000 New Zealand dollars, a figure that had declined from the peak values of the early 1980s, but remained well above his debt. His debt-to-value ratio was 30%. His annual debt servicing cost was 18,400 New Zealand dollars. The neighboring farm that had sold under pressure in 1986 had been carrying 340,000 New Zealand dollars in debt on land, appraised at 380,000 New Zealand dollars at the peak, a ratio that had looked manageable when land values were still rising and milk prices were supporting ambitious expansion. When land values fell and milk prices moved against the operation simultaneously, the structure had no room left in it. There was no bad year it could absorb. The first seriously bad year was the last year. Graham's 1987 season was not easy. The milk payout from the dairy cooperative was lower than it had been in 1984, and his input costs had increased with the broader inflation of the period. His net farm income for the year was 31,200 New Zealand dollars, reduced from the 44,000 New Zealand dollars he had averaged across 1982 and 1983. He drew less from the farm that year and managed the household accordingly. It was a constrained year, but his debt servicing cost of 18,400 New Zealand dollars was coverable from his reduced income. He did not need to negotiate with the bank. He did not need to sell land or equipment. He did not need to reduce his herd in a market where herd reductions meant selling cows at prices that reflected everyone else's difficulties simultaneously. He made his land payment in March. He made his operating loan payment in September. He closed the 1987 farm record with the same notation he used every year: payments current, land debt balance, herd numbers, production per cow. The balance was lower than the year before because he had made the payment. That was what was supposed to happen. Made his payment, closed the book. That's it. No big deal made of it, no celebration. Just a man who built his operation solid enough that when the hard year came, it held. That's the whole story right there. The invisible asset on the Tate farm in 1987 was not visible on any balance sheet in the form that mattered most. It did not appear as a line item labeled conservative debt structure or foregone expansion or the 40 cows he had not added in 1984. What it appeared as was a debt-to-value ratio of 30% and an annual servicing cost that his reduced income could cover. The 40 cows he had declined to add in 1984 would have produced additional milk revenue across the 3 seasons between 1984 and 1987. At the milk prices of those years, the additional revenue would have been real and meaningful. That revenue did not exist on his farm because he had not added the cows. What existed instead was the absence of the corresponding debt, the absence of 80,000 New Zealand dollars in additional borrowings at interest rates that had since moved to 18%, the absence of a lease obligation that would have required the 1987 milk price to hold at 1984 levels to remain serviceable. The absence of a problem is not a thing you can photograph or point to in a farm record. It does not feel like an achievement in the years when nothing goes wrong because of it. It only reveals itself when the thing it was protecting against arrives, and even then, to the outside observer, it looks like luck. The farm survived. The farmer must have been fortunate. Graham Tate had not been particularly fortunate. He had been conservative in 1984 when conservatism looked unnecessary, and the years that followed had eventually produced the conditions that made conservatism look like wisdom.
He had not known in 1984 that 1987 was coming. He had known that something like 1987 was always, eventually coming, because it always was, and that his job was to be structured appropriately when it arrived. Some assets only show their value when the hard years come. The decision Graham made in 1984, the quiet one that nobody paid attention to, that the bank manager noted and moved on from, was worth more in 1987 than anything he could have bought with the credit he had declined. Have you ever made a careful decision that took years before you understood what it had actually protected you from?